regardless of whether you're using single stage or multi-stage walk forward analysis, they both follow this principle, which is you choose a set of parameters, you see how they perform on data they've never seen before. There's a big problem with this approach, even for multi-stage walk forward analysis, which is, let's face it, it's considered the gold standard approach. And like I say, when I have sufficient trades, this is an approach I take myself. So I'm a big advocate of Bob Pardo, and the work he's done, and this is a great approach, but it still uses this technique, which is potentially flawed. Let me show you how walk forward correlation, which is this new technique, is completely different.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
All right, Martyn, welcome back. Part 2. This is really good stuff. I propose we just jump straight in where we left off so that viewers who were halfway through it in part 1 can continue right along where we left off in part 2. And, we'll get through this presentation. And then, I'm keen to know a little bit about what you're doing with AI, what's next for you as well. So the presentation that we've been going through is really about what constitutes best practice for strategy development and optimization. And obviously, perhaps the most important topic in systematic trading. So a really interesting part 1 already. And maybe you could just remind us, bullet point, a couple of things we covered in part 1. Those, I think, 3 points, and we've got another 2 major points to get through. And then let's dive into, the next point, which I believe is around looking at the performance metrics and parameter selection.
Yeah. So last time, I think probably the main message that I was hopefully getting across was that optimizations can be very deceptive, okay? And they can be deceptive because of the fact that they often get so affected, the results get so affected by major market news events, other random events that are non-repeatable. And that makes it extremely difficult for an algo trader to select what the best settings are for a strategy. And it really is a black art in terms of being able to do that. And one of the things that I proposed is this ability to filter out as best as possible those random events, which hopefully leave behind the edge of the strategy. So if you can imagine you're looking at an optimization surface, what you're seeing now is the genuine edge, and it's that edge that is repeatable. So hopefully when you come to test that and validate that on out of sample, and also when you trade it in a live account, it's much more representative, and the results are much more representative of what you're actually seeing in your optimization. So I think that was the main kind of emphasis on the first session that we had.
Yes. All right. Awesome. Let's move right into the next point then.
Okay. So if I just share my screen again, hopefully you can see that, Simon.
It looks good. Yep.
So what I want to do here is really talk about performance metrics. So I'm talking about here things like, the Sharpe ratio, profit factor, metrics that traders need to use in order to do what I was talking about in the past, in the last episode. They're needing to select the parameters and the settings they're going to use in their live account. And we typically use performance metrics to do this. And I continually get asked by other traders, what is the best performance metric? Is it the Sharpe? Is it the return over drawdown? Is it profit factor? What is it? And this is something that I myself have battled with for many years. What is the best metric to use? And if I were to say there's one metric that helps to ascertain the edge of the strategy, which is what we're looking for, it's the profit factor. This is the performance metric I've had most joy with in terms of selecting good settings. Okay.
Mm-hmm.
However, recently, over the last couple of years, I've started to take a different approach. Okay. And that's what I want to talk about now. So let me take you through a bit of the rationale behind this. So if we've got, where are we? Here we go. The thing that you have to realize is that different performance metrics tell you different things about a trading strategy. They tell a different story about it. So there are certain metrics like the Sharpe ratio, like the compound annual growth rate over the drawdown, that focus their kind of attention on the equity curve. And they look at this balance between the reward that the equity curve delivers versus the risk. Okay. Now, Sharpe does this based on standard deviation. If you're looking at drawdown, then you're looking at percentage drawdowns to give you that element of risk. And they're then combined to give you an assessment of what that equity curve effectively looks like. And the higher the performance metric, typically the better the equity curve looks. So that's one category of performance metric. And it's important. It's an important category. But then you've got others which start to look at things from the perspective of the individual trades that constitute and build that equity curve. So I'm thinking here about things like Van Tharp's R multiple. Okay, so this looks at every individual trade and attributes a maximum risk to the trade and says how well, on average, did the trades do in relation to that trade risk. So this is telling you something subtly different. This is telling you if you place a trade in the market, what can you expect to get return for a certain level of risk, usually set by your stop loss. Okay. But again, it's incredibly important to know this, but it's different. It's different than the first type of metric we talked about. And then you've got kind of ratio-based individual trade outcomes. So here, profit factor fits into this. So profit factor looks at, on average, the gains from all of the individual trades compared to the losses of the loss-making trades. How does that metric compare? And I found that this is really excellent at distinguishing how good the edge is from different parameters. The problem lies when you start to say, which is the best metric? If you choose a metric, so you might choose Van Tharp's R multiple, you're only seeing a small slither of the full story here. You're not getting the full picture. And if you choose another metric that is in one of these other kind of categories, again, you're seeing a different slither of information and intelligence about the optimizations and the back tests that you've performed. Okay. So I started to think, really all of these different aspects are important. So how do we get all of the information from all of these into a single metric? And so that's when I started to come up with the concept of a combined performance metric that includes all of these. And it took me a while to come up with the kind of the methodology around how you combine these, because they're completely different, right? So profit factor, for example, the break even for profit factor is a value of 1. Anything above 1 is generally considered good. Anything below 1 is bad. Whereas for others, like Van Thorp's R multiple, 0 is the kind of the cut-off point between good and bad. And likewise for compound annual growth rate, that's based around kind of a 0 level. And they have vastly different ranges of values. But eventually I came up with a solution to this using, for anyone who's wanting to replicate this, really Z-scores. It's a statistical technique, and Z-scores is what you want to be using in order to combine these things together.
Yeah.
And if you're all right, I'll just quickly show you how I've done this in my own software, Simon.
Yeah, absolutely. Love to see it.
So I'll just briefly show you. So what we've got here is a table of results that have come from an optimization. And, I have the ability to look at different individual metrics and kind of look at how they perform in this. And this is what I used to do for many years. Look at the compound annual growth rate over the max drawdown, look at the Sharpe ratio, see how these compare. But it drives you crazy because they all give you different results.
Mm-hmm.
One set of parameters will be best for one metric and a completely different set of parameters for another metric.
Mm.
So because they're looking at different things, you expect that to happen. And so I came up with this concept of a combined ranking. And what this does is, if you look here, so in this particular case, I'm combining the performance here from Sharpe ratio, compound annual growth rate over the mean drawdown, which is one of my favorite metrics.
Yeah.
Rather than the max drawdown, I think it actually tells you more about a strategy. Also, Van Thorp's expectancy and profit factor, and combining them into a single ranking. So what you then see here, and if your viewers take this same approach by producing these kind of metrics, what you see is a ranking that's more balanced. It's a balanced view of how well these settings perform, looking at all of those different characteristics of a trading strategy. And I found this to be a far better way of getting intelligence about the process you've been through and making much more informed decisions.
Does that allow you, Martyn, to have a more intelligent objective function too if you are doing walk forward analysis or something like that? Would you use this as your objective function?
So in terms of walk forward analysis, this is something that I used to use, religiously. So by this, I assume you mean the kind of the Bob Pardo multi-stage walk forward analysis.
Mm.
So I used to use walk forward analysis all the time. And for some strategies, that is absolutely the gold standard of, the gold standard approach currently is walk forward analysis. Where walk forward analysis starts to not be as effective is when you have strategies that don't produce a sufficient number of trades to be statistically significant. Okay, so if you have, for example, a single stage optimization with a walk forward out of sample stage, if you've got a huge number of trades that form part of that, it is then feasible to break it up into a multi-stage process, which has the advantage, of course, of staying in tune with different market regimes as they change throughout that time period. That's great. That is the way you should be doing it. But what I found is that there's a lot of trading strategies where you can't get sufficient sample size to make that approach valid. And so when that's the case, I've found a single stage to be much more effective, because it's this trade-off. It's a trade-off between statistical significance of your result, which you get in a single stage, and the ability to show how a strategy adapts to changing market regimes. And if you have sufficient sample size, great, do it. But if you don't, and most of the strategies I trade don't, so I tend to stick the vast majority of time with single stage.
Yeah. Okay.
But I will talk, in fact, the next thing I want to talk about, which is the real biggie.
Yeah.
I will talk about how a new technique that I've developed can be used in conjunction with walk forward analysis. So I will talk about that a little bit more in the next stage.
Awesome. All right. So anything else that you want to cover on that? That
Unless you've got any questions, Simon.
metrics? Well, no, not really. I like that. And by combining metrics, obviously you can, into the metric that works for you, you can streamline your process, and you could automate it easier as well. Like you can shuffle through ideas quicker because something just stands out. You've got a headline number that you trust, that you like the look of, that gives you enough feedback to iterate quickly, to sort and rank over. So yeah, it's a really great idea. All right.
Okay.
Cool. No, well, happy to keep moving because I'm very much looking forward to this next section.
Yeah. Okay. So what I want to kind of take a little step back and look at what the standard approach, or the kind of the traditional approach that traders have taken for forever almost, and just to set the scene for this new technique that I've developed, and to show you where this would actually fit in this process. Okay, so most of your viewers will already be familiar with this, but I think it's necessary for me to go through it to kind of position where this new technique fits. So if you look at this, so this is from my perspective. When I'm developing a trading strategy, I typically use 12 years of data. And sorry, that's not moving forwards. There we go. And I split that in a ratio of 3-to-1 between my in-sample data and my out-of-sample data. Now, the in-sample data is where I do the vast majority of my analysis work, my development work of a strategy, and so on. So any trials that I'm running, any back tests, any preliminary optimizations I perform are all done on this in-sample data. And I really consider the out-of-sample data to almost be sacrosanct. I have to keep that untouched until the very final stage, where I typically perform the validation that I need to perform. So typically here, this is where traders would perform a walk forward backtest on data that had never been seen before by the strategy. So you're really testing out all the work that you've done in this in-sample stage around the trials, the development, the optimizations, and everything else. You're testing out how that then works on data it's never seen, which is, of course, completely analogous to what you will then do when you go live. Because when you go live, again, the strategy's never seen that data, and so you're almost trying to replicate what will happen when you put your strategy live. So generally speaking, you should never use this data for optimizations. Okay. Now, there is an exception to that, which I'll come on to in a moment, but you should never be using it for optimizations that you then make decisions about the best settings, because you'll be introducing a look forward bias, and to be quite frank, you cannot trust the results that you're seeing anymore. So keep this for your validation stage. So traditionally, after you've gone through this and you've done your final optimization, you'll then take what you consider to be the most robust parameters and you'll test them on this walk forward validation out of sample data. What I think is a much better methodology, and this is the new technique that I've been developing over. I said to you in the first episode that we had, I've spent a decade really trying to hone the whole process of strategy development into a better process. And over the past kind of 12 to 24 months, this is something that has started to develop, and it's now at the stage where I've proved that this is a really, really effective technique that kind of improves dramatically the traditional approach. Okay. But what I want to say is, regardless of whether you're using the traditional approach or this other methodology that I'll talk through with you today, the next stage here typically is that you would run what's called a pre-live optimization. And this optimization would use exactly the same settings that you used for your final optimization. And the only reason it's best practice to do this is that you're effectively now saying, okay, I've made my decision. I am going to trade this strategy. So let's now find the parameters that work best on more recent data. Okay, so you have to be at the point at which you've either decided, no, I'm going to throw it away, so I don't need to do this, or yes, I validated it on the out of sample. It is good enough to trade, and so now I perform a pre-live optimization. The difference now is that when you select your most robust parameters, these are what you're going to use in your live trading.
Martyn, can I just ask a quick question there? The pre-live optimization data looks like you're looking at, say, the more recent, 2/3 or 9 years or whatever it is.
Right,
there.
up to date, yes, yeah.
Would you not just at that point use all the data?
So you could, and that is a technique that's used. I prefer not to. I prefer to keep everything, absolutely everything, the same as I did in my final optimization. So I did my final optimization on 9 years worth of data with a particular set of parameters that I optimized and values that I optimized. And I want to replicate everything just to make sure that I'm not introducing anything different that might change the way I then select those parameters.
Okay.
Everything has to be the same for me, which is why I shift it forward and use the most recent 9 years, which is kind of more in tune with current market dynamics, and you're incorporating those most recent 3 years now. So hopefully that would produce better parameters for your live trading than the parameters you got from the in-sample optimization previously.
So with those two steps together there, does that mean that the out-of-sample data is always the more recent, or is it sometimes relevant to take that 3 years and select the out-of-sample period based on particular regime, or put it in the middle of the time period, or is it always just generally you leave it till the last section and that's that?
For me, it's leave it to the last section and that's that. And the reason, again, is for consistency between this development stage and the pre-live stage.
Yeah.
Because in the development stage, you did your optimization and then you tested that on the 3 years of data after that period. And so again, for consistency, I want to use that approach on pre-live. And it just so happens now that the data after is the live markets. But
Yeah.
consistency again. So I'm not a great advocate in terms of using out of sample data that isn't the most recent.
Mm-hmm.
Because when you go live, you have no choice. You're always going to be using the most recent. So my
True.
view is you may as well be consistent in your development stage.
Yeah. All right.
Okay.
Got it.
So I mentioned walk forward analysis there. So let's go into a little bit more detail about what the difference is between the traditional approach, between walk forward analysis, and why I believe walk forward analysis is better. Okay, so let's imagine with the traditional approach, you've performed an optimization. Okay, so you've got some kind of results that you're either viewing in tabular form or you're viewing as a surface or whatever. Doesn't really matter. You will make some kind of a judgment from that data about what the most robust area is of the surface. Now, what a lot of novice traders would do is they just choose the highest value. Okay.
Mm-hmm.
That can be dangerous because the highest value isn't necessarily the most robust value. And we looked a lot at this last time in terms of how different values can be influenced by noise. And if you look at this particular example, look at what this highest value is right next to. It's right next to this hugely loss-making part of the surface. Okay, so it only takes a relatively small change in market regime in the live environment to kind of drop off a cliff in terms of performance. So for me, this point would never be something I would choose. It's just too close to this hugely loss-making part of the surface. So for me, I'd always want to move into maybe this point, even if it's not got quite as high performance, because this is further away in that parameter space from this negative area. So for me, this is a much more robust area. Now, in the traditional approach, if I were selecting this point, what I'd now do is I would take those settings and I'd run them forward on the out of sample data and look at what the performance was. Okay, and so at this point I get some kind of a backtest equity chart that I then make a decision on, and I'd either be saying at this point this is good enough to trade, or no, it isn't good enough. So I either go back to the drawing board or I throw the strategy away. Okay, and this is the approach that's being taken regardless of whether you're using single stage or multi-stage walk forward analysis. They both follow this principle, which is you choose a set of parameters, you see how they perform on data they've never seen before. There's a big problem with this approach, okay? Even for multi-stage walk-forward analysis, which is, let's face it, it's considered the gold standard approach, okay? And like I say, when I have sufficient trades, this is an approach I take myself. So I'm a big advocate of Bob Pardo, and the work he's done. And this is a great approach, but it still uses this technique, which is potentially flawed. Let me show you how walk forward correlation, which is this new technique, is completely different. So here, you perform your in-sample optimization in exactly the same way. There's no difference. So everything that's happened up until this point of performing your final optimization, after your development, your trials, everything else, is exactly the same. The difference then is that instead of comparing how this works with a single set of parameters on the out of sample, you look at the entire n-dimensional parameter space on the out of sample data. Okay. Now, obviously, this is going to look kind of a little bit different to the surface you're seeing on in-sample. But the analysis that you then perform is that you take every single parameter value. That's important, not just one. You take every parameter value.
Yeah,
So
because
this
normally
one
a
here,
walk forward, you'd be taking the best parameter set
yes,
only forward. So that, yeah, just to really call it out again, you're
yeah,
talking about not just a walk forward process as normal, but looking at all or a huge range of the matrix of different parameter settings and running them again out of sample.
every single one. That's right. Okay. So for example, this one, which I think, so this, if we're looking at the chart here, we're looking at a parameter values of 120 and 250, okay, on two parameters. So you find the same parameters on the out of sample and you see how they performed. And this is the key bit. What you then start to do is to plot this data on the walk forward correlation chart. Okay, so you can see here you have on the x-axis you have the in-sample values, and on the y-axis you have the out of sample values. These are the performance values. So for example, if you were using Sharp ratio, this is the in-sample Sharp values, the out of sample Sharp values. Okay, so for this point we've got here just a single point. You then plot that on the chart. So hopefully you can, it's a little bit small.
Yep.
Hopefully you can see the blue point that's appeared there. So you've plotted the in-sample result, the out-of-sample. Okay. Don't look at the axes. This is just kind of just for illustrative purposes.
Yeah.
So then you do that with the next point. Okay. I've just used the other corner here just because it's easier to pick them out. And you plot that relationship on the chart also. And the next one, and the next one, and you do it for every single point. And eventually you end up with a scatter chart that is the walk forward correlation chart. Okay. Now this is an absolute gold mine of information now. Far superior to just looking at what the backtest looks like on that single set of parameters. So let me take you through some different scenarios of what this chart is likely to look like. Okay. Sorry, I should have said at this point, you need to perform a calculation of what the correlation is. Okay. So you can either use Pearson correlation or Spearman correlation. I prefer Pearson at the moment. That might change in the future. I'm doing some work on different calculation techniques, but you'll come out with a value that will be between 0 and 1. 1 means perfect correlation. 0 means no correlation. Okay.
I just like looking at those charts there. Go back, Martyn. I mean, I was already speculating on where you were going because you can see on the charts, the two mountain landscapes, they're relatively similar. The valley of the shadow of death is in the same place, and the peaks, the victory peaks, are in the same place roughly. So the result is a high correlation, suggesting that the parameters performed in a similar way out of sample as they did in sample, which is really telling us something about the stability of the model.
Exactly right. Okay, so in this particular case, that is the case. When that isn't the case, you might get something that looks instead like this. Okay, so here you kind of struggle to see any pattern whatsoever. So in terms of the measurement of the correlation, in this particular case, this is zero or close to zero correlation. Now, what does this tell you? First of all, it tells you one of several things. You've probably overfitted your model. And I'll just run through a scenario here as an example. Look at this point here, top right. Okay, let me circle it. There you go. This point top right is a really important one because in the in-sample data set, this is that these are the parameter values that performed best. This is the peak. It's the highest peak on your optimization surface. Okay. Now let's go back to what would have happened in the traditional approach. In the traditional approach, you'd have selected this and you'd have tested it on out of sample. But look, on out of sample, this is positive. So you're going to get a decent looking backtest curve. Okay, fantastic. Most people would see this and say, we're getting somewhere here. This definitely got potential. And they'd either say, I either trade it live now or I do a little bit more work on it, on the strategy, and then trade it. Well, this has definitely got potential. But remember, what walk forward correlation is telling you is that this is completely random. This doesn't have any potential whatsoever. Okay. And in fact, if we'd chosen the second highest peak on the chart, which just happens to be this one down here, okay, so on the x-axis, this is the second highest. If that had just happened to be a little bit higher and you tested that on your out of sample data, it would have produced a curve that looked like this. And you'd have probably thrown the strategy away. So just because these 2 points were just slightly different, you've made a completely different decision. For the top point, you've said, great, strategy works, it's past validation. Bottom point, nah, doesn't work, throw it away. Okay? Complete opposites. Just because they were slightly different performances. Okay? But you will not make that mistake with walk forward correlation. So I need to be clear that walk forward correlation like this is not the method that you will use to select the parameters first and foremost.
Okay, yeah, right.
You would still use the approach that you've used in the past. Okay. The difference is that walk forward correlation is giving you the go or no go to even get to that stage. Okay. So for example, if your walk forward correlation looked like this with zero correlation, this is a huge red flag that says to you as a trader, don't even bother trying to select the best parameter. Because the fact is that this strategy has no discernible edge. Okay. Everything's random. And it has no predictive power. Okay, that's important. It's telling you that the process you've taken and the model you've developed has no predictive power. Because the in-sample results bear no relationship whatsoever to out-of-sample results.
Yeah.
There's no relationship there. There's no predictive power. And so why would you even then try to go back to an optimization chart to try to select the best parameters, because you know that has no bearing on how they will perform in your live account. No bearing whatsoever.
This is really quite an innovative approach, Martyn.
It is. I think it is. And I truly believe that this will become the de facto methodology. Okay. And just to be clear, this technique works both with single stage validation and so on, but also multi-stage. So Bob Pardo's walk forward analysis, it could still operate with that. And you could get one of these charts from every stage of the process to get a really good view of whether your model was being truly predictive at each stage of that process. So it actually works in combination.
You heard it here first on the Algo Advantage. This is,
you did.
I mean, if you're watching this show right now and you are not subscribed, what are you doing? Like, subscribe. Gosh, we are an underrated quant trading podcast. Let's just say that. But all right, wonderful.
So let's move on, okay? So through some other scenarios here. So what we've got here is we're starting to see a pattern visually, okay? You can measure the correlation here. It's a correlation of about 0.25. We're seeing a pattern, but we're also getting, as you can see, some kind of outliers here. Okay, it's not a perfect model by any stretch. Okay, but what it's telling you is that probably you have been subject to some overfitting in this model, but there are certain areas of the surface that are beginning to show genuine edge. If you select a value with a high in-sample performance, you're likely to get a positive out-of-sample performance. This is really important because this now tells you, okay, the model works. So it might be worth moving forward to that next stage where you do now select the best parameters from the surface, the most robust parameters from the surface. Okay, so it has some predictive power, but then also with a low correlation like this, a low positive correlation, it also indicates there might be a bit more work required first before you move forward. Okay, but if you get something like this, you know now you're kind of onto a winner. You know that there's limited overfitting with this kind of pattern. And you can already see that because you've got quite a lot of points in this upper right quadrant, there are areas of the surface that have genuine edge. Okay, so you've developed a strategy at this point that under some settings has genuine edge, which is great news. And this has very good now predictive power. If you're choosing high values in sample, you're getting high values out of sample. This is really positive. You could be even better, a correlation of 0.9. This has extremely good predictive power, but you're unlikely to see this kind of result in reality. Okay.
What kind of trade counts are you looking at in your strategies to make this statistical analysis valid? I think we did cover this on part one.
Yeah, we did.
But yeah, I and particularly for these, presumably even in that outer sample period, one needs quite a few trades.
Indeed. So, when I covered this in part one, and I would, if people have come straight into part two, I would recommend you go back and watch that, because one of the things I talk about is statistical significance and how important that is, and how easy it is with low trade sample sizes to be misled by the information you're getting. So for me, an absolute kind of hard limit is 1,000 trades. Anything less than that, and I won't really consider the strategy, because I don't believe I can get statistically significant results from it. But this technique, actually, walk-forward correlation, will either confirm or otherwise that assumption, okay? Because remember, the number of dots you're getting here aren't the number of trades. The number of dots you're getting on the walk-forward correlation side is the number of different parameter combinations you tested. So even if you've only got 10 trades, you could still have, significant number of points on the scatter chart. So what would typically happen with low numbers of trades is you would get this scatter chart you see on the left, in my view. If you've only got a strategy that produces 100 trades, you're probably going to get a walk-forward correlation chart like the one on the left that has no predictive power, because your results, your individual results, don't have any significance from a statistical point of view. So this will tell you that, for a start. It will actually help you determine, because when you get this thing on the left, you don't know at the moment what the problem is. The problem could be statistical significance. It could be that you haven't got enough trades, or it could be that you've just simply developed a strategy that, despite what your instincts told you, it doesn't have an edge in the markets. Okay, so there's a whole range of things that that this chart on the left tells you, and of course you then have to go away and investigate it. What is the problem? Is it the edge of the strategy, or is it the sample size? What's the issue? Okay, but remember, with the old approach, you wouldn't know that. All that you would know is pick the top point, get good results, move forward, trade it in live. But guess what? If you traded this in live, it would almost certainly be break even or loss making, I would say, after you've added charges. Okay, so that's the difference between the two approaches. Make sense?
Yes, it does, and that's fascinating. And viewers should be reminded that I, write a lengthy article with every podcast on Substack. So I'm looking forward to. I should get you to validate before I send it out. But looking forward
Please
to
do. Yeah.
exploring this and writing, and maybe that's actually a really great idea. And just really delivering as much value as possible. But no,
Definitely, because this is a new technique, and I want you to get it right, Simon. So get me to validate it. I'm sure it will be right.
Yes, no, 100%. Let's do that. That sounds great. Really cool.
So let me just quickly tell you where I'm kind of going with this. Okay, so in a nutshell, what does walk forward correlation do? It gives you that gate. It gives you the go or no go gate. Okay, and it will, I can guarantee, it will save traders so much pain and money, because you continually hear the stories where traders say it performed great, even out of sample validation, it performed really well. I put it live and it lost money. What's going on? This gives you the answer. It tells you what's going on. You just got lucky. You just got lucky that you chose a point that happened to perform well on out of sample data, but there was no real edge there. Okay, so it tells you, walk forward correlation tells you, have I overfitted my model? And it tells you, does my strategy have a discernible edge that I can then make valid decisions on to choose parameters that will work in out of sample and will work in the live account. That's what it does in a nutshell. Okay. So I know you're going to put a link to this, Simon, in your article. But so this preliminary research paper, I've developed a paper as an independent researcher, and this is published on a research website called SSRN. I've also put some kind of a dialogue around this on my own site, which I've got the link for here. So it'd be great if people could, take a look at that to get more information.
Yeah.
But interestingly, to really take this whole approach further forward, I'm now working alongside the economics department of a really prominent UK university, and working with their research team to really expand the scope of what walk forward correlation does. So we've been working on this now for some time, and this is going to get published in a really prominent quantitative finance journal. So we jointly believe that this has huge potential, and as Simon said, you heard it here first.
Wow.
So we truly believe that this will become the, if you like, the de facto methodology that certainly quants will use, because we just believe that they will build this in as the new approach. But also in terms of the retail space, because I'm sure many of your viewers are retail traders as well. One thing to bear in mind, the software that, as you know already, Simon, because you've taken a look at it, but the software that I've been showing you is a software package predominantly that I developed for myself for my own trading strategy development. But I do then also make that available to other retail traders. And interestingly, this walk forward correlation technique that until now I've been doing manually. So basically, through a combination of Python scripts and everything else, I've been doing this research manually, that will be built into that software, which makes this approach really, really accessible to retail traders. So just wanted to kind of make that point. This isn't just for the quant space. I'm trying my best to make this an accessible technique to help retail traders be better traders and to help turn that corner to become profitable. Because too many retail traders lose money. That's a fact.
Yeah, well,
so
100%.
hopefully this is a technique that will help.
Yeah. Right. Well, that was definitely my next question, looking at the complexity of that exercise and asking how you did that in your software. So you're building that outer sample, in sample correlation analysis into your software. So the software that you've got, which, by the way, I've been chatting to Martyn for a while about this stuff, so he's happy to offer my members a discount on this software, so we'll set that up as well. But links below, I guess. Tell me just a bit more about the software in general, Martyn. What does it do now? And obviously it'll be doing this walk forward correlation stuff in future. Give me a bit of an overview of what it does and how it works.
Sure. Okay. So I mean, I've shown different elements of this as we've gone through the different techniques, really. But we looked at in the previous one, we looked at this ability to filter out these random events. So the whole concept here is that this is a post-optimization process. Okay, so at the moment, the trading platforms that I work with are just MetaTrader MT4 and MetaTrader MT5. Okay, I'm also working on development right now for NinjaTrader, and I am completely open to support any other platforms that have an optimization capability in the future. So the whole premise of this software is that you run your optimization in the platform that you currently use. The information then gets sucked into the optimized strategy platform where you perform the analysis. So you run the optimization in your trading platform, but you don't analyze the data in your trading platform. You analyze your data here, where the level of sophistication around the data science aspects and the intelligence you can get from that data is probably far superior to any individual trading platform. And remember, this is a decade worth of experience that I've put into this software. So you have this ability to smooth out that surface by taking away those random non-repeating events to retain what is the genuine edge of the strategy. Okay, to be able to make better decisions. In about 3 weeks' time, by the way, you'll have a button down here just underneath this chart, which will say perform walk forward correlation analysis. Okay, and that's how you will perform what we've just looked at. So that will tell you actually whether it's even worth looking at this chart or not, to try and select those parameters. So you also get a whole host of different performance metrics that you can use to perform your analysis. Usually in trading platforms, you decide before you do the optimization what you're going to use. So you decide at the beginning, I'm going to use Sharpe ratio, and that's all you get. With Optimize Strategy, it allows you to look at your results across all of those different metrics, just from a single optimization. So you get the full picture. And as I said before, you get this ability to use the combined metric as well. Okay. Now, This table at the top, the smaller table, it's small for a reason, and that's just because it's there for comparison. You should never use this table. This table is the results that were taken directly from your trading platform. So these are the results, for example, that MT5 produced or MT4 produced. Okay. The table at the bottom is the one that's had the necessary, filtering out of news, filtering, looking for those robust areas of the surface for you. So you don't actually need to manually say, is this point close to a cliff edge? This does it for you. And it also looks at sample size. Okay, so how statistically significant are each of these results? And you can see those here. You've got the performance, the variance, and the sample size. And they are all used to rank the results that you've got. So, and as you can see, it's chosen completely different parameters to what the trading platform chose as the best. Completely different. And that's because you just cannot rely. I call them raw results. The results you get from your trading platform are raw. They're just the result, not taking into consideration anything else, not taking into consideration the variance of the surface, the sample size, the performance across multi-metrics, and so on.
Mm-hmm.
The table at the bottom here is what you would actually use to make your decisions, okay, because it takes account of all of those. But of course, you'd only do it if the walk forward correlation had said, yes, you've developed a predictive model. So 3 weeks' time, the walk forward correlation will be there.
Amazing. All right, Martyn, gosh, yeah, there's a lot in this across both the shows. Obviously, we needed 2 episodes to get through it all. There's some very novel stuff in here, and it's hugely interesting. I think my audience are going to find it very fascinating. I again will remind everyone that they should follow along on Substack and read the articles that go along with this, and that's where I will also post the links to discounts for that software, and to your paper, Martyn, to your website, and so on.
Thank you.
Yeah, some I'm just digesting all of this, so lots to think about, and this is why I love podcasting and being in this position to talk to so many of my trading colleagues doing cutting edge work and learning constantly, which is fantastic. And we get to share this now in the community. So for the Algo Collective community, our paid members get to do a little bit more with Martyn now, because we're going to go into a section that I've wrung from you, highly proprietary information. I really pressed you because I wanted you to go through your multi-step process, or to walk us through those steps that you don't normally talk about online, of what your sort of building robust strategies process kind of looks like, which is the ultimate hot topic in systematic trading. So I really appreciate it. But what have I missed, Martyn? Anything else before we say farewell?
I'd just like to thank you really for the opportunity of coming on the podcast. Anyone who goes to my website will see I have a kind of a mantra there, which is to be the best algo trader I can be, but also to help other algo traders succeed. And I've got a real passion to help, in particular, retail traders be more successful. As retail traders, the odds are stacked against us. And so I like to do what I can to help provide tools that I've shown you, provide information. So it's why it's such a pleasure to come onto a podcast like your own, Simon, and be able to share some of that information. So it's been a real pleasure. Thank you for your time.
Yeah, it really has. Thanks again, Martyn. Yeah, we're in the same boat there. We're both trying to give back and feed something into the community that is very different to a lot of the hype and nonsense that you can find online about trading. So, and they're the kind of people that I'm attracting around me, which is really good. All right. Well, yeah. Thanks once again, Martyn, and let's talk again soon.
Perfect. Thanks, Simon. Bye now.